rates, earnings, China, of course, the Fed, too. So what's an investor to do? Let's ask Dan Greenhaus. He's Solus Alternative Asset Management's chief strategist, here with me at Post 9. That's a growing list of pressure points, right? We've been sort of fixated on this Apple sell-off. The rates have backed up, although at least today they're backing off, which is maybe why the market's kind of hanging in. Okay, how do you see things here?
Yeah, I mean, listen, technically, obviously, we've sliced through the 50-day moving average on a number of indices, if not all the indices. But in the context of Apple, I'll take a somewhat optimistic spin on things. Apple and those types, they were up 60, 70%. Meta, Nvidia are up 300-400% off their respective lows, either earlier this year or late last year. In the context of what's happened with rates, from the bottom, and when rates bottomed earlier this year, the 10-year's up, call it 100 basis points, and the NASDAQ is up the whole time, the S&P is up the whole time. I think ultimately, with all that as a backdrop, what you look at right now is it's not unusual late August, September to have something of a seasonal pullback. I know this is something Josh Brown was talking about this afternoon.
Yeah.
September's been down 3 years in a row, 6 of the last 9, et cetera, et cetera.
Yeah, historically, it's not a great time.
It's not a great time. That's right. And when you have the run-up that you had into something like that, you have no catalyst right now. Jackson Hole's probably not going to be much of anything. And so you're sort of on hold, at least to NVIDIA next week and then beyond.
Okay, so all that said, then, if we have a little swoon here, which, you know, some said was due anyway, are we still set up for a trend that's intact for the rest of this year to be constructive on stocks?
So I think on balance, the answer is yes. I want to add one more data point or one more observation, what I call the Terra Nova observation.
All right.
Something he's been talking about is the distance the S&P, where the index got from its 200-day moving average. The NASDAQ got almost 22% away from its 200-day moving average, a level that's basically only been exceeded 5% of the time over the last 40 years or so. So again, within the context of a correction, you were pretty extended in that sense, and Joe's been hitting that point, I think correctly so. In terms of the rest of the year, listen, I think the bias is for no recession right now. And again, for context for the viewers, I'm someone who was arguing much of last year for a recession sometime around the middle of this year. Obviously, that is not going to be the case. And if anything, ironically, the economy appears to be accelerating. I know that you're aware of the Atlanta Fed GDP Now number that everyone's talking about.
Right?
It's not going to be 5.8.
Even if it's a point less. Even if it's 2 points
it's less. Going to be about 3%. But let's say it's 3%.
Yeah.
That's still an acceleration from Q2, which itself was an acceleration from Q1. So perversely, again, not only are we not having a recession, we appear to be accelerating.
But it also appears as though we've entered a phase of the market where good news is bad news.
I think that's right.
Again.
Yeah.
Right? If you put a print that's too hot, or you have a metric that's too hot, a report that comes out, it's too hot, that's not good now. Whereas before, it was, okay, soft landing, hey, maybe even no landing. Now it's like soft landing good, no landing bad.
Well, listen, again, I think we've been talking about this forever, but it bears repeating ad nauseum. We're not really talking about meaningful additional rate hikes on the part of the Federal Reserve. What the good news...
Well, you better hope not. The bulls better hope not, right?
Yeah, well,
we've convinced ourselves that, okay, September's going to be a nothing burger, and then, okay,
it might not be, but
maybe in November,
yep.
And then that's it. If it's more than that, is that a problem?
No, I don't know if one more hike is necessarily a problem, although I will say we know that the headline CPI accelerated last month. I'm not sure that everyone is aware that in the upcoming report, it'll probably accelerate again, perhaps meaningfully so, at least at the headline. And so you're going to have somewhat of a jitter, so to speak, around 2 consecutive months where headline CPI has gone up. But on the part of the Fed, again, and I can't say that stress this enough for investors at home, it's not how many additional rate hikes. It's how long you leave rates up at these elevated levels. It's considerably more consequential for the economy and I think for your investments.
Well, it's also the speed at which rates have gone up. That's part of the issue with the unsettled nature of this edgy market is, you know, the 10-year's gone up a fair amount in a reasonably short period of time. It's made people nervous. Now, it's, as I said, it's backed off today. But over the last couple of weeks where the uncertainty started to really creep into the picture, that's been the case.
Yeah, well, again, the issue is how do you want to view the backup in rates? So I mentioned before, I'll repeat, the 10-year's up, call it 100 basis points or so in the last few months. It's a pretty rapid move. But is it going up because the economy appears to be accelerating, as I mentioned, in which case interest rates should be higher? Or is it going up because yield curve control out of Japan, or the higher level of issuance, or perhaps people are getting more nervous about inflation? That tells you a lot from your own viewpoint about what you think about the investment landscape.
I thought Goldman's Tony Pasquarello, frequent guest on this program, had a pretty good read on exactly what the environment looks like right now in his latest note, which I read earlier, quote, liquidity ebbing, price action skittish, tactical nerves are suddenly a bit frayed. That makes sense, right?
Yeah, I think that sums it up very nicely. But again, outside of the seasonally weak period in which we find ourselves, what you have to wrestle with as an investor beyond the next few weeks, let's say through the end of the year, as you mentioned, is do you think there's going to be a problem on the earnings front, or do you think there's going to be a problem on the economic front? Because if you do, you're making one of two arguments. On the earnings front, it's obviously earnings. On the economic front, perhaps I don't want to pay 20 times for the market anymore, although a lot of that is tech, in which case one of those two levers, so to speak, is going to be how you get the market lower. If you don't have those concerns, then you're probably just going to drift higher into year end, which is typically what happens.